What if I told you the real difference between how you manage money and how, let's say, a billionaire does? Isn't really about how much you have, but it's more about how you actually see, how you perceive the money you have. Kind of crazy, right? But that's exactly what we're diving into today, the framing effect.
You hit the nail on the head. It's wild, isn't it? The same info, but just presented in a different light, can lead us to make totally opposite choices. This framing effect, it's a big deal in behavioral finance, and it shows just how much presentation really influences our choices, no matter what the facts actually are.
So that's what we're going to unpack in this deep dive. We're on a mission to explore this framing effect, to see how people who built huge fortunes, maybe they use it naturally, or maybe they do it on purpose, but we want to know how they use it to make smart money moves. And more importantly, how can you, the ambitious professionals, the entrepreneurs, the investors listening, how can you use this same mindset for your own financial success? And we're not just talking theory here. We've got insights from behavioral finance plus real-world examples to make this practical for you.
And something to always keep in mind as we start is that, sure, luck plays a role. Maybe you inherit some wealth. But lasting success with your finances, it really comes down to strategic thinking and putting specific principles into practice. The cool thing about what we're talking about today is that these principles aren't just for the super rich, they're for everyone. They can really help you no matter where you are on your financial journey.
Okay, so let's get into it. When we talk about the framing effect in the world of behavioral finance, what are we really getting at?
So the framing effect, it's basically how we react to something, how we make decisions based on how that situation is presented to us. It's like putting a frame around it. This frame, it includes the context, the words used, even those little cues that come with the information. And it's a core idea in behavioral finance, which, as you know, says that we don't always make financial choices based on pure logic. We're influenced by, well, our psychology and those mental shortcuts we all use.
Right, so it challenges that old idea that we're all perfectly rational, economic robots.
Exactly. Daniel Kahneman, the Nobel Prize winner, and Amos Tversky, they really changed the way we think about how we make economic decisions. Their research showed us that in the real world, we often make choices with incomplete information, we're biased, we're emotional, and that's where the framing effect comes in and has a big impact.
So let's go deeper. How does this framing thing show up in our financial lives? What are some ways it changes the choices we make?
One of the biggest ways framing works is by making us think about potential gains versus potential losses. It's the basis of prospect theory. And the interesting thing is that how we feel about risk totally changes depending on whether we're thinking about what we could win or what we could lose. Usually, when there's a chance to gain something, people want to play it safe. They'd rather have a smaller guaranteed gain than a maybe bigger but uncertain one. But flip the situation, make it about potential losses, and that same person might suddenly become a risk taker because they want to avoid losing anything. This change in how we feel about risk, depending on how it's presented, that's called the reflection effect. The key takeaway here is that our willingness to take risks isn't set in stone. It changes based on how the choices are presented to us.
It makes sense. The thought of losing something usually feels way worse than the excitement of gaining something of the same value, like better safe than sorry, right?
Yeah. You got it. And that brings us to loss aversion. Tons of research has shown that the pain of losing something is much stronger, often twice as strong, than the happiness of gaining something of equal value. This imbalance in how we feel about gains and losses, it really affects how we make financial decisions.
Can you give us a real-life example of how this gain versus loss framing could play out with investments?
Imagine two investment options. Option A is presented as having an 80% chance of getting you a $1,000 profit. Option B is described as having a 20% chance of not making any profit. Now, most people, when they hear this, they'll probably go for option A. The guaranteed profit feels safer, even if it's smaller. Okay, now let's say we change how we present these options. Option A is now framed as having an 80% chance of having $1,000 more than you invested. Option B is framed as having a 20% chance of ending up with the same amount you started with. Mathematically, it's the same thing, but when it's about potential gains, people tend to choose more conservatively than when it's about avoiding losses.
Wow, that shows how just changing the wording a bit can steer our choices. It really makes you realize how important it is to understand the numbers, not just how they sound. What are some other ways this framing thing messes with our financial perceptions?
Another interesting thing is how framing can change how we see value. Studies have shown that when people are offered a discount for sharing their personal data, they're more likely to share it than when they're told they're being paid for it, even if the amount of money is the same. Reframing it as a discount instead of giving away data shifts our focus from losing privacy to gaining a lower price.
So it's like we always want to feel like we're getting a good deal.
Exactly. And this connects to something called mental accounting. We mentally put our money into different categories, maybe a housing fund, a travel fund, an investment fund. This can be good for budgeting, but it can also make us do irrational things because of how we think about the money in each category. Like that concert ticket example, losing a $150 ticket versus losing $150 in cash. Logically, it's the same loss, but we've mentally assigned the ticket money to entertainment, so losing the ticket feels like a double loss in that category, making us less likely to buy another one.
Yeah, the concert ticket example is always a good one. It really shows how these mental categories affect our spending. Okay, so let's switch gears a bit. Do you think understanding framing could help us understand the money strategies of super wealthy people? Is there a billionaire mindset when it comes to framing financial decisions?
It's hard to say there's one billionaire mindset, but we can see some patterns in how people who've made a ton of money might approach framing. They tend to focus on the long game, building wealth over time, so it makes sense that they probably frame financial decisions with a much longer time horizon than someone focused on just making ends meet each month. For them, a little dip in the market or a drop in asset value might just be a small bump in the road of their long-term growth plan. The key here is that a long-term perspective can help you not freak out over short-term changes that usually bother less experienced investors. They see a 10% market dip not as a disaster, but as a potential 10% discount on future gains.
Like they're not looking at just one tree, they're seeing the whole forest, right?
Exactly. Also, they've learned how to analyze things from running complex businesses and making big deals. So they're probably better at reframing situations to see hidden opportunities or risks that others might miss. Think of someone like Warren Buffett, the king of value investing. He sees market downturns not as something to be scared of, but as chances to buy assets that are suddenly cheaper. That ability to reframe bad news into potential profit is a huge advantage.
So it's about looking beyond the surface and seeing the real value underneath.
Right on. They've also taken big risks and seen huge rewards, which probably changes their reference points when it comes to potential gains and losses. What might feel like a huge loss to someone with limited capital could be a minor adjustment for someone with a massive diversified portfolio. It all depends on their overall financial perspective.
Makes sense. Someone at that level probably has a different tolerance for risk. What about the basic ways they build and keep their wealth? Does that involve a certain kind of framing too?
Absolutely. Think about how wealthy people often buy assets that increase in value businesses, real estate, big shares in companies, instead of just piling up savings. That's a strategic way of framing things. They're not focusing on the immediate satisfaction of spending their income. They're thinking about long-term value and ownership. Even the way they get returns can matter. For example, getting regular dividends from investments can feel like a steady income, which might make them less likely to spend it impulsively compared to getting a big one-time profit from selling something. Framing returns as steady income instead of a windfall can change how they spend and help them keep their wealth over time.
Wow, this is really interesting. So for those of us who aren't billionaires yet, how can we actually use these framing ideas to make smarter financial decisions in our own lives?
This is where the real work begins. One important thing is to reframe losses as learning experiences. Don't dwell on past mistakes or setbacks and let fear of loss hold you back. Instead, try to see them as valuable lessons. Ask yourself, what did I learn from this? What can I do differently next time? When you reframe a loss as a lesson for future success, it takes away some of the negative emotions and helps you make better decisions going forward.
I like that. It changes the focus from failing to learning and getting better. What else can we do?
Another great strategy is to focus on the long-term gains, not the short-term ups and downs. When you're thinking about your investments or making financial plans, train yourself to look past the day-to-day changes and focus on the big picture, years or even decades down the line. This is what successful investors and entrepreneurs often do. By focusing on the ultimate goal and not getting distracted by every little bump along the way, you can avoid making emotional decisions that could mess up your long-term financial plans.
So it's about taking a step back and seeing the bigger picture, even when things feel uncertain right now.
Exactly. And then there's opportunity cost, which people often underestimate. When you're thinking about spending money, don't just focus on what you're getting. Think about what else you could do with that money. Invest it, pay down debt, save for the long term. Framing your spending decisions in terms of the potential future opportunities you might be giving up can help you make more thoughtful choices. Maybe that daily coffee, when you think about how that money could be growing in an investment over many years, starts to look a little different.
It's about seeing the unseen, thinking about what you're not choosing.
Exactly. You also need to challenge the status quo. We often stick to certain ways of thinking and behaving with money just because that's how we've always done it. But regularly question your current financial situation and look for different perspectives. Reframe your current assumptions to spot potential blind spots, hidden risks, or new opportunities that you might not see otherwise. Ask yourself, are there other ways to approach this that I haven't thought of?
So be curious about your own finances. Don't just go with the flow.
Right, and think about diversification as a strategic framing tool. Instead of seeing diversification as maybe limiting your gains in one specific investment, think of it as a way to protect your whole portfolio from big losses. It's about framing your investment approach around stability and consistent growth over the long term, rather than chasing those high-risk, high-reward opportunities in just one area. Diversification becomes a way to build a more resilient portfolio.
So it's like a safety net for your long-term success, not a limit on potential gains.
Exactly. And when you have a big financial decision to make, try to see it from different angles. Talk to financial advisors you trust, read different opinions from reliable sources, and consciously try to see the situation in different ways. The more ways you can look at a problem, the better you'll understand it and the better your final decision is likely to be.
Like looking at a jewel from different sides, each side shows you something new.
That's a great way to put it. It's also super important to be aware of how the media frames financial news. Remember that news outlets and social media often frame information to get your attention and make you emotional, which can lead to biases. We might overreact to recent or dramatic events. Be careful about thinking risks are bigger than they are just because of sensational headlines. For example, the news might make a big deal about a stock market drop, making it seem like a crisis, even if it's just a normal correction in a generally upward trend.
That's a really important point. We need to be smart about how we consume financial information and recognize the potential biases in how it's presented.
Absolutely. And lastly, think about the subtle differences in how you see different types of financial returns. We talked about this before, but for long-term wealth building, it can make a big difference if you frame investment returns as a chance to reinvest and grow your assets, not just as money to spend right away. Focusing on building equity and owning assets over the long term is a powerful way to frame your wealth building efforts.
So it's like seeing returns as fuel for future growth,
Yep.
not just a reward for past investments.
Exactly. Now, as we become more aware of this power of framing, it's also important to know about those cognitive biases that can get in the way of using these more strategic approaches.
Like what kinds of biases?
One big one is regret avoidance. This can lead us to make bad financial choices just because we want to avoid feeling regret later. For example, we might hold on to an investment that's doing poorly for too long because we don't want to feel bad about selling it at a loss, even if it's the right thing to do. It's important to base your decisions on objective analysis and your long-term goals, not on the fear of feeling bad in the short term. Sometimes not taking action can lead to more regret than taking a calculated risk.
So being afraid of regret can actually trap us in a worse financial situation.
You got it. We also have to watch out for the overconfidence effect and the illusion of control. These biases can make us think we're better than we are, or that we have more control over the market than we actually do. This can make us underestimate risks and make bad financial choices. It's important to stay humble and objective when you're assessing your finances and to get different perspectives, even if they challenge your own.
So it's about balancing confidence with a healthy dose of reality.
Exactly. And finally, be aware of the disposition effect. This is our tendency to sell winning investments too early and hold on to losing ones for too long. This is often because we frame gains as something to lock in quickly and losses as something to avoid admitting to. But if you reframe your selling decisions based on your original investment plan and the future potential of the investment, not just on how the price is moving right now, you can improve your long-term investment performance.
This has been seriously eye-opening. So, to sum it up, the framing effect is this powerful psychological force that shapes all of our financial decisions, often without us even realizing it. But when we understand how it works, we can be more aware of the frames we're using and choose more strategic ones. We can start thinking more like those people who made a ton of money.
That's exactly right. By consciously reframing how we think about our finances, focusing on the long term, carefully considering opportunity costs, seeking out different viewpoints, and being aware of how information is presented, we can all make clearer, more intentional financial choices and ultimately achieve better results.
So now that you know about the power of framing, take a second to think.
Yeah.
Is there a financial decision you're facing right now that you could look at from a different angle? What new insights or possibilities might you discover by reframing it? It's a question worth thinking about long after this deep dive is over.
We encourage you to keep exploring these cool ideas from behavioral finance and see how they relate to your own goals, both in your career and your personal finances. The more you understand the subtle but powerful forces that shape your decisions, the more you can take control of your financial future and make it what you want it to be.